So I talked a little bit about how economics is really about managing shortages. I mean, not everything exists in infinite quantities. There's a limited amount of everything in this world. But what does it come down to in terms of limiting things? Well, it comes down to this: money. Well, okay, you may not recognize this as money. This is $5 Hong Kong from 1971. And it's an interesting example of money as we might know it. First of all, what is money? Well, in practical terms, you might have one of three different views of it. If you don't have enough of it, money is what you need to get by on a daily basis, that constant scramble to get by, to get the scratch you need to survive. If you have too much of it, you might see it as a way of keeping score, whether or not where you rank with respect to everybody else. A most useful definition of money would be what you need to get things done, to buy the things that are in short supply, to make something new or manufacture something of use to people. Those are the practical definitions of money, but of course, economists have something, well, a little more precise, a little more academic. Economists will tell you that money is one of two things simultaneously. It is a store of value and it is a medium of exchange. What does that mean? Well, if you emphasize the store of value, you want your money to be something that is in relatively short supply, that's going to hold its value. That's where gold and silver come in. That was a very important part in the early days of trading and so on. But something that is in very short supply, well, it remains in short supply. If the economy grows, if more things are produced, then there's not enough of it to go around. And this became a problem once again when the Industrial Revolution came. A modern industrial economy needs a much more flexible definition of money. Simply because something that is in terribly short supply is what? Going to get more and more valuable as time goes by. There's going to be inherent deflation, right? The money itself becomes more valuable. We'll get back to that in a little bit. But somewhere in the 18th century, a new definition of money was invented, and that's where things like, this paper currency becomes very, very important. Now, this $5 Hong Kong is not issued by the government of Hong Kong. There wasn't really a government in Hong Kong, was there? This is the Hong Kong and Shanghai Banking Corporation, right? You might know them today as HSBC after things happened in Hong Kong. They tried to rebrand themselves. But they used to basically print their own money, and as such, they were kind of the de facto government of Hong Kong for all practical purposes. And it says the Hong Kong and Shanghai Banking Corporation promises to pay $5. Isn't this $5? What is this promises to pay? Well, that used to be common on all currency. You see, this is what we call a banknote. It's something that is issued by a bank. And all money used to be issued by banks. In fact, today, if you look at American dollars, it's a Federal Reserve note issued by a bank, the Federal Reserve. Well, you need to understand where all money comes from. What generates money? And the answer is all banks, everywhere, generate money. Because all money is debt. Let me explain this. See, banks have what we call fractional reserve. They don't have a big pool of dollars that are put into the bank and then are lent out to various people. No, they only keep a small amount of money in place and they lend out against that to a larger amount. How much do they have on hand? Well, it's a lot complicated, of course, but they're required to keep about 8% of what their total loan package is has to be kept in actual fixed assets, only 8%. Now, there are actually categories of assets that are done. 4% has to be really, really good stuff. 4% can be, but, and this changes from one country to the next. But basically, for every dollar that's put into the bank, there is a total of $12 that can be issued. Wow. So where does money come from? Well, to expand the money supply, what happens is that the Federal Reserve fixes interest rates. The interest rate is something which determines how much money is going to be paid against Federal Reserve deposits and so on. But it also influences the bond market, the market for U.S. debt. And I'm going to stay with U.S. examples here because it's the easiest for me to explain. Bonds are issued with a fixed payment with time. Okay, so if you have a 3% interest rate on the bond, then you buy a $100 bond and the government will pay you $3 every single year. For an interest rate to go down, what that means is the underlying value of the bond goes up. So if the interest rates fell to, let's just say 1.5%, because I can do this math, that means that the bond value goes up to $200. The bond becomes more valuable. So when interest rates drop, the bond's value goes up. This is extremely important because this U.S. debt is what determines the shape of everything in the economy. If the Federal Reserve decides that interest rates are going to go lower, then bonds go up. So a bank that has, let's say they have $8,000 in the bank. It's a tiny little bank, all right, because they have $100,000 in loans against that. Well, suddenly now interest rates are dropping. That $8,000 they had sitting around is now worth what, $16,000? They can loan another $100,000. And that's how you control the money supply with interest rates, because the underlying assets in the bank become more valuable. Therefore, they have more money to lend by a factor of about 12-ish, 12.5 to 1. Okay? Money is created by banks, and all money is debt. The Hong Kong and Shanghai Banking Corporation promises to pay $5. Well, if this isn't $5, what is $5? Well, let's not talk about that. But this is a promissory note. And we used to call them that. We sort of dropped that language, but that's where it all came from. Now, what this allows is for the money supply to go up and down. The reason I wanted to talk about different views of how to maintain an economy first, before I talked about money, is that you have to understand what it is that we're trying to do when we talk about something created called money. The Friedmanite view is that it's all about managing that money supply. Make sure it goes up and down in the right way, and it maintains a store of value as the economy grows. Now, debt is not necessarily bad. If you have, say, an idea for a factory, something that you're going to produce tomorrow, once the factory is up and operating, a whole bunch of stuff, well, money from tomorrow coming into today in the form of debt that is kind of created spontaneously by the bank means that tomorrow arrives. And that debt becomes useful things, right? It's always good. You want to have a house? Well, you're going to have a house for 30 years. Let's bring that money from 30 years backwards into today and spend it now. You can see that debt is essentially moving money from the future back into time in a certain way of looking at it, without getting too Doctor Who about it. But this is important. The money supply can go up and down as interest rates are adjusted, and we can keep everything on an even keel. And money becomes the same value from time to time, regardless of how much the economy grows. So before when I was talking about, we have the Keynesian view that it's all about managing supply and demand, well, of actual goods. You can see that this is dependent on the debt that's created in order to fuel having enough money in the economy. The Friedmanite view, which is the one that dominates today, is that it's all about the money supply. But creating money means creating debt. And then there's that Fisherian view, that all economic cycles are caused by too much debt. Yes, that's the one that there isn't really a political philosophy around, is there? But it's extremely important. And I'll tell you why it's important, because as I was talking about how much debt we have in this country, about 4 times gross domestic product is the total debt of the whole economy, and about 25% more than the whole economy is just the federal debt alone. As we create more money, we create more debt because money is debt. We're essentially moving resources from the future back to today. And the only way to manage that is what? Constant growth. The more debt we take on, the more growth we need. But when there's a lot of debt, growth becomes difficult. And that's where it gets interesting. You see, with all of the money that has been printed or created by extremely low interest rates in the last 20 years, long after this beautiful little bill was created, with all of that debt, you would think tremendous expansion in the money supply. I mean, money is subject to supply and demand like anything else. If you have too much of it, you should have inflation. Well, we don't have inflation. So where is all that money going? The answer is that if you think of that money as a force that wants to inflate things, there must be a corresponding deflationary force. And there are several key deflationary forces, but one of them is indeed debt. The more people have for debt, or corporations have for debt, the more their monthly overhead increases, the more their nut that they have to reach every single month just to stay alive increases along with it. And that's the problem. You expand the money supply, you expand the amount of debt. Oh, but we don't have enough money. Well, let's expand the money supply some more. Let's expand the debt some more. Oh, but the debt is limiting how much we can spend. Well, we need more money in the system, so we have more debt. And we wind up in a cycle. And it is the nature of money itself that is creating this cycle, because money is debt. And none of this would be going on in the world today without an increase in debt. So, cancel the debt? That should get rid of this deflationary problem, right? Yes, but there is more to it than that. You see, again, money is subject to supply and demand. How many Hong Kong dollars do you want? Well, if you're in China, you might want a lot of them. But there are other forces at work. Demographics. As people get older, they tend to spend less. They are more careful because there's only so much to go around, right? You're not at the peak of your earning potential. If there's an excess of capacity, back to that Keynesian problem, let's just say that the developed world has built factories like crazy as developing nations try to keep up with each other. Let's just say that happened. Well, it did happen. Then there's an excess of production around the world. That tends to be deflationary as prices drop. But more important than anything else, in terms of deflation, is that technology tends to be deflationary. I mean, just look at a computer or any device. The price of them drops every single year, right? Today's technology is worth less tomorrow because it's outdated. Technology is inherently deflationary. And so there's a tremendous amount of deflationary pressure, and there has been for a while. So we have created more money to try and keep everything on an even keel, right? We don't want our money to drop. I mean, after all, the whole system of debt is based on interest payments. The time value of money is critical in this whole thing. So we can't have deflation. I mean, if money only becomes more valuable tomorrow, then how do we have something called interest, which is based on the tax, essentially, of bringing money forward to today? So we can't have deflation. So we have to print more money. So we create more debt. So we get into this cycle. And yes, the debt is the major driving force right now, but technology is as well, in addition to the demographic and the overcapacity problem. In other words, what we're seeing right now is something like the death of money as we know it, because there is simply too much debt. And when you look at this problem of terrible lack of resiliency in the economy, if the basic overhead of life is very, very high because of the debt load that absolutely everybody, every corporation, every government, everywhere is creating, well, then missing 1 month of payments because of a lockdown is a death sentence. Not as bad as the virus, but it is dangerous. And that's the problem we have now. We are in a time of deflation where money is actually more valuable with time, and it makes more sense to delay payments, more sense to delay purchases, more sense to just simply wait because it's going to just increase in value. You might say we might as well be on the gold standard, or maybe for that matter, Bitcoin. Yeah, cryptocurrencies become fascinating. But it's important to start with an understanding of what money is, because money is debt. And whether you take a Keynesian view or a Friedmanite view, you're going to wind up increasing debt as you attempt to increase the money supply, regardless of where it goes. Now, the problem with really rapidly increasing the amount of debt is we all know who gets it first, right? I mean, the banks are going to make out the loans to the rich customers, or as Mark Twain always said, a bank will loan money to anybody who doesn't need it. So you wind up with a sense of sort of inflation at the top, but not enough money at the bottom. This is the income disparity that has been fueled by these debt cycles. And we also do see inflation in things that can be considered investments, such as real estate. I mean, prices generally are not rising, but the cost of getting an apartment or a house is going up because those are potentially investments. So we have inflation in certain areas, anything that can be seen as an investment, but deflation for everybody else. A bifurcated economy. And when you have something like the stock market, I mean, the money has to go somewhere. And so it went into stocks like crazy, like you wouldn't believe, until, well, here's the thing about the free market. If there is too much money around, the free market finds a way to get rid of it. If it can't use inflation, it will incinerate it. And at the first sign of trouble, boom, $15 trillion disappeared from the US stock market. It disappeared like it never really existed in the first place. Because in a certain sense, it didn't. See, as we move more and more towards a world where this money doesn't go to produce tangible physical assets, but instead goes to things that are manipulating other money, credit default swaps, other things like that, other good ideas financially, it's not producing anything. We're moving money from the future to today for the purpose of just sort of feeding the machine, feeding the debt monster, as it were. And so the net result is that money is broken. The Hong Kong and Shanghai Banking Corporation promises to pay $5. What is $5 that you promise to pay? I mean, if this ain't it, well, this isn't it. This is a promissory note. This is debt. And all money is debt. It used to say things like that on it, but it doesn't anymore. And this is very, very important, because getting into the cycles of deflation and why this is damaging are very important. We can do whatever we want to try to expand the money supply, but we're only expanding the debt at the same time. And that actually causes more harm than good. And when you look at these events over the last 20 years, 9/11, the 2008 Lehman collapse, and now the coronavirus lockdown, you can see, well, yeah, they were traumatic events, certainly, but should they have caused so much damage? The answer is no. We have no resiliency because we have too much debt. And we have too much debt because we're constantly trying to increase the money supply. And we're doing that basically pushing a rope. There are other factors at play which are putting us in a deflationary spiral. And that's what we need to really talk about. And it doesn't matter whether your view is Keynesian or Friedmanite. Eventually, the Fisher view is going to bite you. And that's what's happened to us. All right? I'll talk to you tomorrow.